Today, a very important daily update because we've had a huge number of statements made in just a single weekend. We've also seen the crypto market take a pretty violent dump last night. It's still in the process of grefting. And we also have Trump, who is once again, and like never before, threatening Canada, this time with the risk of a historic monetary intervention that could turn the market upside down and wipe out the value of the dollar, and also have repercussions on the crypto ecosystem. We'll also talk about the American shutdown, which threatens to happen in 5 days. In short, it's safe to say we've got quite a lot to cover today. But let's dive right into this daily update with what shook the market last night. Because Bitcoin experienced a pretty violent move last night. And of course, the rest of the market followed in the drop. As a result, we're talking about more than $40 billion wiped out in just 3 hours. And a Bitcoin that dropped. And it's still below $88,000. But this kind of movement is part of the infamous Sunday night dumps. If you're used to the daily update on Mondays, you know what I'm talking about. That's when liquidity is at its lowest. That's when there are the fewest traders behind their screens. In other words, this isn't really a true market reaction. It's simply a genuine movement. And the real price always comes the next day, when the American markets reopen. By the way, they reopened. We went back up to around $89,000. And then, after that, it corrected slightly. And precisely, let's look at what happened and where things stand today. Because this excess volatility is dragging the price of Bitcoin below $87,000 to $88,000. And it created a new CME gap between $88,000 and $89,200, as you can see here. And today, the price is moving toward that area. In any case, we've tested it. This famous CME gap, maybe by the time I release this video, the gap will be filled. But that's not the case yet, though. Maybe today. We'll see. Because we'll see that the last CME gap took 3 to 4 days before it was filled. And that's still a technical factor that carries some weight. We also have, and let's move on to a piece of news, one of the stories that made headlines this weekend and caused so much volatility in the markets. Apparently, the geopolitical climate wasn't explosive enough, because Trump has just played his trade card again. Because this time it's against Canada, as he is now threatening to impose 100% tariffs on all Canadian products if the country finalizes its strategic partnership with China. By the way, we'll come back to that. But you should know that Canada sends 75 of its exports to the United States, which amounts to more than $450 billion in a single year. And with a 100% tariff, almost all of its products would become uncompetitive overnight. And so, Trump justifies this threat precisely by citing the risk of trade diversion, because, according to him, if Canada strikes a special deal with China, then Chinese companies could go through their products through Canada to bypass the American tariffs. In other words, to use Canada as a gateway into the United States and undermine the entire trade strategy he has put in place against Beijing. And we already know that tariffs can simply cause a cataclysm in the markets. And the markets absolutely do not like this kind of uncomfortable position, especially when it comes with such a heavy threat as a blanket 100% tariff. And inevitably, after such a serious threat, we have Canada's response, which was not long in coming, as the Canadian government has just officially announced that it has no intention of pursuing a free trade agreement with China. So this is rather good news, because we have Prime Minister Mark Carney, who reacted directly to Trump's warnings, while reiterating that Canada remains fully committed to this famous agreement, CUSMA. So it's the free trade agreement between Canada, the United States, and Mexico, which also obliges Ottawa to notify Washington before any negotiation, with a country classified as a non-market economy, which includes Beijing. Here, as you understand. And so Canada is either backing down in the face of this American pressure or simply stating the facts. And it puts an end to any speculation about a potential commercial rapprochement with China. So it's a decision that speaks volumes about the fragility of the current geopolitical balance, and about Washington's enormous influence in this area of trade negotiations. And while the markets are digesting these trade tensions, there's another macro shockwave. This time it's one that's brewing and is much bigger than people think. It's the Fed getting ready to sell dollars and buy yen for the first time since the last century. Hold on tight, because we talk about this often, and it's coming up more and more. This time it's a direct intervention in the foreign exchange market. It's such a rare tool that just the rumor of it, which is what's happening right now, is enough to make all asset classes tremble. Because the Fed has already carried out the famous rate checks, which is exactly what happens before a real intervention. So, in other words, the United States is preparing to support the Japanese currency. And the last time this kind of intervention took place, it completely reshaped global markets. And now all the indicators are aligned because Japan no longer wants to defend its currency alone. And not for much longer either. And when the Fed actually steps in, the impact is simply global. But concretely, if the Fed intervenes, what happens? Well, it's very simple. It'll sell dollars, so it'll buy yen. If it buys yen, the dollar will go down, and therefore global liquidity will increase. And historically, assets, especially risky assets, so to be clear, financial assets, tend to pump. So, obviously, that brings us back to crypto. Because Bitcoin has one of the strongest inverse correlations with the dollar, and one of the most powerful positive correlations with the yen. So it's an explosive combination. But be careful, because we'll need to follow this story very closely, since if the yen strengthens too abruptly, let me explain, all the investors who use the famous yen carry trade I told you about a few weeks ago will have to unwind their positions. And they'll have to do it urgently. And we've already experienced this in 2024. A small movement in the yen caused Bitcoin to crash, remember? From $64,000 to $49,000 in just a few days. And if you want to understand why, crypto markets have also become extremely sensitive to the slightest currency movement. You just have to look at what's happening with the dollar. Because now we're not just talking about a simple macro signal, we're talking about the biggest drop in the dollar in all of modern history. Because here we have the DXY, which is the symbol, the ticker symbol. Basically, for the dollar, which has just posted a drop of 15.6% compared to its 2022 peak. So today it's fallen back below 97 points. The last time we saw a drop of this magnitude was in 2017. And what happened right after that? There was a massive flood of global liquidity and one of the most intense bull runs or bull markets, you can call it whatever you want, ever seen on Bitcoin, with the price multiplying by 100. This kind of movement is anything but trivial. I had to tell you about it. Because when the dollar drops, money naturally looks for refuge elsewhere. And that elsewhere is always the Shang. That is, risky and liquid assets, like gold, as you've seen recently, then stocks and also cryptos, can simply react. That's why this drop in the DXY is the most underestimated macro factor at the moment. And I had to talk to you about it in the Dale's Update. Don't hesitate. Don't hesitate to like, subscribe if you're interested in this kind of information, and leave me a little feedback in the comments. And actually, this dynamic with the dollar doesn't stop there, because it's not just a price drop. Its global influence is also crumbling at a staggering, even historic pace. And you can see it here. Because the dollar's share in global foreign exchange reserves has dropped from 65% in 2001 to just 40%. Today you can see it on the chart. And as if the situation wasn't explosive enough with all the volatility, and I'm not even talking about Nika, the threat of the next virus that's currently attacking Ingress. I was just looking at that right before the daily update. But anyway, let's not add even more Fed to the Fed and just stick to the facts. But we have geopolitical tensions, and now there's also a major risk with a potential shutdown. And that's in 5 days. Because according to Polymarket, let me zoom out a bit here, you can see it. The probability has now climbed to 81%. And that's no coincidence, because Chuck Schumer announced that the Democrats will vote against the current funding bill. And on the other side, the Republicans are still refusing to budge on the budgets. So both sides are completely deadlocked, and the clock is ticking, little by little. And if no agreement is signed before January 30th, so the end of the month, part of the federal government will shut down. And we remember very well what that means. Because the last shutdown lasted 43 days, remember? And it left real economic scars. So nobody wants to go through that again, except for those who want to accumulate and buy, precisely during these kinds of periods. But for now, the votes just aren't there, clearly. And in the markets, this kind of uncertainty never goes unnoticed. I had to tell you about it. See you tomorrow for a new Code Assurance. Don't hesitate here if you want to secure your crypto. You have a very simple solution called Tangem. I'm sending you to this video, and I'll see you tomorrow. I'm going to have a drink because I was starting to dry out live on air. Let me remind you that I don't make any cuts in the daily videos. I give it to you raw, the analysis, so you get the information directly. This was Jillian. See you tomorrow for a new video. Until then, take care of yourself. Catch 'em.